Hello my friends and welcome to Finance Logic YouTube channel. My name is Evgeny and this video is about managerial accounting. This video is about introduction to variance analysis. Variance analysis is a very sophisticated and very technical topic of managerial accounting, and many students and many users of managerial accounting feel some problems in understanding of how we estimate variances. Let's begin. Why do we need variances? By the way, variances are deviations from what we expect, deviations from budget that we have to analyze somehow in order to estimate impact of decisions that we make during our reporting period. We want to control costs using variance analysis, because we have some budgeted costs and it's very useful to check it with actual ones to determine whether everything was good or we have some areas for improvement. We can use variances to evaluate performance of employees or group of employees, because each variance is responsibility of one or more workers. And we can use variances to investigate problems, because of course we want more to investigate problems than to investigate some positive moments or meeting budget targets. So variance analysis is used to explain profit gap. The main purpose is to explain why actual profit is different from budgeted profit. So this is, we may call it as a profit gap. And let's define three big reasons why our actual profit is different from expected, is different from budgeted one. The first reason is that we have deviations in input and output prices. Actual prices of what we sell and what we buy are different from expected, are different from budgeted, because it's impossible to be 100% precise. Our budget is based on our forecast about prices, volumes, and so on. And of course, actual figures would be different. So the first reason is prices of what we sell and prices of what we buy. In practice, usually we use average price for a period. For example, average price of material that we buy. Reason number two is efficiency. It is about how efficient we transform our resources into finished products or services. We have some standards, we have some budgeted standards and expectations, and actual figures may be also better or worse comparing what we expect. And reason number three is about volume. Volume of our product or services. It is about what we produce and what we sell. So here we have three big reasons, and these reasons could be splitted or divided into many variances that can be estimated separately. Now let's talk about cost variance. So if we investigate actual costs and budgeted costs, and we investigate the gap between actual and budgeted costs, what are the reasons of this deviation? We need to do some adjustments here, because for costs it's a bit different comparing to profit. If we talk about cost, we can eliminate output price. Obviously, only input prices have impact on our cost. Only price on material, labor, and any other resources that we buy. Efficiency has impact on our cost, because if we consume our materials efficiently, we spend less materials. And that is why efficiency should stay as a reason for cost variance. And let's talk about volume. Of course, if we produce more, we have to spend more. If our actual production is more than budgeted. But let's think, is it bad that our actual costs are higher than budgeted because of increase in production. Of course, it's not very good thing, but it's a normal thing. Because if we produce more, we have to spend more, and there is nothing to investigate. Of course, we may have difference between actual and budgeted cost due to increase in volume, but it is not what we have to investigate, and it is not what we have to estimate separately. That is why volume is not reason for cost variance. So it's very important to understand that volume, of course, has impact on costs, but it's not a variance, it's a difference. Now let's take a look at illustrative example to make it more clear. Let's assume that we have the following actual and budgeted figures about material costs. Our budgeted material costs are 300 and our actual material costs are 2000. So if we compare these numbers, we can say that we observe very dramatic increase in material cost, 1,700. But is it that bad that it seems? Let's take a look at the reasons why we have increase in cost. The main reason is that we have produced 50 units and we plan to produce only 10. So $300 were budgeted to produce 10 units of finished products, and 2000 were spent to produce 50 units. It's five times higher than budgeted figures. So conclusion that we need to have based on this example is that actual and budgeted costs, if we compare them as they are not comparable, unfortunately. And that is why it's not so easy to perform variance analysis. So it means that 1,700, it's not a variance, it's a difference. And it is not a number that we have to investigate and we have to analyze. But what we have to analyze, the idea is very simple. We don't have to compare 300 and 2000. We have to compare our actual results with our budgeted results, but for the same basis, for the same volume of units produced. It means that we have to do one substitution. Instead of budget for 10 units, we have to use budget for 50 units. And it means that if we meet all our budgeted standards, our cost should be 1,500, but our actual costs are higher, they are 2,000. So we have eliminated impact of change in volume on our costs, and now we can say that the difference between actual costs and budgeted cost for actual volume, so budgeted cost for 50 units, is variance, and it calls total material cost variance. It's 500, and that is what we have to investigate. And the reason for this variance is material price growth from $3 to $5, and another reason is improvement in efficiency, because according to budgeted standards we should consume 10 kilos per 1 unit, but actual consumption is less, and this is a positive thing. For variance analysis, it's very important to make our numbers comparable. If we update our budget for actual volume of units produced, keeping all other parameters the same, we now can compare budgeted cost for 50 units with actual cost for 50 units of finished products. And now these numbers are comparable. Now let's determine material cost variances that we have at a very high base level. We have total material cost variance that includes price variance and usage variance. Total material cost variance is estimated as the difference between budgeted cost for actual output. So in our previous example, it was budgeted cost for 50 units minus actual costs. Actual costs are by default for actual output. To estimate material price variance, we have to compare actual and budgeted prices. Prices per 1 kilo or liter or whatever measurement of our material is. So we compare prices and we multiply this difference by actual volume of materials, by actual usage. To get monetary result that tells us about how change in price impacts on our costs or impacts on our profit. If we want to estimate material usage variance, usage is about volume. We compare budgeted volume with actual, but here we have to do very important adjustment. We have to compare budgeted usage for actual output. It means how many kilos we have to use in accordance with budgeted standards, but for actual volume of units produced. And we compare it with actual usage, with actual volume. And change in volume we multiply by price. And let me give you some tip. For example, if you study variance and you have to pass some exams, the tip is as follows. When we estimate variance, and if we have change in price, we always multiply by actual volume. In this example, it is actual volume of material used. If we have in our brackets as a difference change in volume, we multiply change in volume by budgeted price. So if we need to use price out of our brackets, price is always budgeted. And it doesn't matter what kind of variance we deal with. If we need to use volume out of our brackets, volume is always actual. Now let's go back to our example and let's define total material cost variance, price and usage. So total material cost variance is the difference between budgeted cost and actual costs. But wait a second, they are not comparable because they are for different volume. We cannot compare these costs. We have to update our budget and estimate our budget for 50 units. And our total material cost variance is 500. It is adverse. Now let's estimate price variance. We have to compare prices, budgeted price and actual price per 1 kilo. They are comparable because they both are for 1 kilo. Budgeted price is 3, actual is 5, and we multiply it by actual volume of total kilograms used. Total kilograms used is 400 because material consumption actual is 8 kilos for 1 unit of finished products. So total consumption is 400. And that is 800 and it's adverse. This formula helps us to define whether variance is adverse or favorable based on its sign, because we subtract from budgeted price actual price. If actual price is higher, it's bad. It results into adverse variance. So the logic tells me if total variance is minus 500 and price variance is minus 800, then usage variance should be positive plus 300. Let's check it. So we have to compare usage. Our budgeted usage is 100 kilos because we have to spend 10 kilo per unit, 10 kilos per unit for 10 units. And our actual number is 400. And we multiply it by budgeted price. Remember that price outside the brackets is always budgeted. But wait a second, these numbers are not comparable because they are for different volumes. It's not correct to estimate in this way. The correct solution is that we have to compare budgeted usage for 50 units. For 50 units, we expect to use 50 multiplied by 10. And we compare it with actual usage, with 50 multiplied by 8. And we multiply it by $3 as a budgeted price. And we get 300. It is favorable variance because it was caused by improvement in efficiency. Probably we decided to buy more expensive material, but this material in terms of its quality, in terms of its consumption, is better than material that is supposed by our budget. And this is a very common picture because it means that probably we buy more expensive material than material that was budgeted. And on the other hand, this material is more superior in quality. and it has less wastage, it has less losses, and that is why consumption is better. Now, let's recap our results. So we have total material variance of minus 500, it's adverse, and it consists of two reasons: price, minus 800 adverse, and usage, plus 300 favorable. Now, let's take a look what we have about labor cost variances. Here the situation is almost the same. The only difference is the names of variance. We have total labor cost variance that we can divide into labor rate and labor efficiency variance. Total labor cost variance is estimated as budgeted cost for actual output, for actual volume of finished product, minus actual costs of labor. Actual cost of labor is by default for actual volume of finished product. Labor rate. Labor rate variance is the same as material price and estimated based on the same formula. We take the difference in price of labor, we take the difference in rates and multiply it by actual hours, by actual volume of hours spent. And we get impact of change in rate on costs and on profit. And efficiency labor variance is the same as material usage variance. We compare volume of hours and we multiply this difference by budgeted price. Budgeted price is budgeted labor rate. And here we have to pay attention that we don't use budgeted volume of hours. Instead, to make our hours comparable, we have to compare budgeted hours for actual volume with actual hours. So we have to ensure that we compare comparable numbers, that we try to estimate difference between comparable figures. Now let's take a look at the following example. For some of you it may be a bit complicated, but it's quite good to understand what we have to do. It's quite good to learn from mistake that many of you may have in solving this example. Company planned to produce 10,000 units of finished goods and to spend 500 hours in upcoming month. So this is budgeted figures to produce 10,000 units and to spend on this production 500 labor hours. Actual production was 9,500, which required 400 labor hours paid at $4 per hour. This is actual information about actual figures. Labor rate variance is 0. Last sentence means that labor rate, budgeted labor rate and actual labor rate are the same. We need to answer what is the labor efficiency variance. I'm going to give you 15 seconds and then I will try to show you right solution. If you need more time, you can always stop the video. 15 seconds. Let's start. Labor rate efficiency. It is about comparison between hours. We compare budgeted hours with actual hours, and you may think that right solution is as follows. We have to compare budgeted hours with actual, 500 and 400, and we multiply this difference by budgeted price, budgeted rate in this example. That is $4 per hour. And it is 400, the result is 400, and it corresponds to option D. If you have answered D, I'm sorry, you are wrong, because this is not right way to find labor efficiency variance. Pay attention, you cannot compare 500 hours, which were budgeted for 10,000 units, with 400 hours, which were actually spent to produce a little bit less volume, 9,500 units. What you have to do? You have to update your budgeted hours and to estimate how many hours you have to spend in accordance with budgeted standard. What is budgeted standard here? Budgeted standard is how many hours we need to produce one unit. it is 0.05 hours per unit. If we apply this standard to actual volume, we can find how many hours we have to spend in accordance with budgeted standards. And now we can compare it with 400. So we estimate budgeted hours, but not for 10,000. Instead, we estimate budgeted hours for 9,500 units. Now we can compare it with 400 units, and we multiply it by $4, and we get 300. And the correct answer is C. The variance is 300 and it's favorable. Now let's continue with sales variances. Variances that come from sales figures and price at which we sell our product. First variance is sale price variance. It is estimated using the same logic that we have already discussed. If it is sale price variance, the reason of variance is price. That is why we need to estimate change in price and multiply change in price by actual volume of what we sell. Pay attention that here we take actual price and we subtract budgeted price in order to get the number which sign determines whether variance is favorable or adverse. If we have positive figure, variance is favorable. If we have negative figure, variance is adverse. And this variance shows the impact of change in sale price on our profit. And the next variance is called profit volume variance. So obviously the reason of this variance is change in volume of what we sell. And it is estimated as actual volume minus budgeted volume. And as usual, change in volumes we need to multiply by budgeted price. But in this case, it is not the same because the variance is called profit volume variance, not revenue profit variance or something like that. It's called profit volume variance. That is why we need to use profit per unit outside our brackets. That is why we multiply change in volume by budgeted profit per unit, not budgeted price per unit. Because here we need to take into account an impact of change in volume on profit, not on sales or revenue. This variance should demonstrate an impact of change in volume on profit. So let's continue with the practice example. Production and sales are budgeted at the level of 10,000 units with total cost of 30,000. Budgeted price is $5 per unit, actual production and sales are 9,500 units, priced at $6 per unit. We need to estimate sales price variance. I'm going to give you 15 seconds and then I will start to show you the solution, but you always can stop me if you need more time. To estimate sale price variance, we need to compare sale prices. Budgeted price is 5 and actual price is 6. So we need to take a difference, 6 minus 5, and we need to multiply it by actual volume as usual. Actual volume of sold units. And as a result, we have a favorable variance of $9,500. And the next question, to estimate profit volume variance, 15 seconds or more if you need. Profit volume variance. Be very attentive here. We need to take volumes, we need to take a difference in volumes, and we need to multiply it by budgeted profit per unit. So what do we need here? We need to estimate budget profit per unit. That is 5, that is price, budget price, minus total budgeted cost per unit. To get per unit figure, we need just to take total costs and divide them by budgeted volume. So we get $2 per unit. So this is our budgeted profit per 1 unit of product. And then we need to take the difference in volumes and we multiply it by $2. So we get 1,000 as an adverse variance. And this adverse variance is very often correlated with positive favorable price variance. So price is higher, volume is lower because maybe we lost some customers due to unexpected increase in sale price. Now, finally, let me demonstrate your reconciliation statement that reconciles budgeted profit with actual profit using the same numbers that we have in our previous example, adding actual cost figure. Assume that we have actual cost of $29,000 and we need to reconcile actual and budgeted profits. And prepare a variance report for the period. So this report shows the difference between our profits and the reasons why this difference exists. So let's start. Our budgeted profit is 20,000. We just take our level of sales, multiply by price, and we subtract total costs. Our budgeted profit is 20,000. Our actual profit is estimated using the same way. We take quantity, multiply by price, and subtract total cost. So our actual profit is 28. And our total profit variance is 8. And it's positive. So please pay attention to the very important thing. In this example, we earn more than we expected to earn. And on one hand, there is no reason to investigate because we have a very positive figure. But we may have some negative factors that have been offset by positive ones. And in order to identify possible negative things that may occur in our company, we need to perform a very detailed variance analysis. And in this example, we need to estimate all variances that we can using the information provided in the scenario. At first, let's estimate profit volume variance. Let's compare volumes and multiply it by budgeted profit. We have already done that a few minutes ago, and we know that it's minus 1,000, so it's an adverse variance. The next, let's estimate sales price variance. We know that it's positive. It is 9,500, so these numbers are the same like in previous example. And also here we can estimate total cost variance. Total cost variance, it is the difference between costs that we expected and costs that we actually have. Costs that we expected are not budgeted costs, are costs that should be, but for actual volume. Remember that when we compare costs, we always need to compare budgeted costs for actual number of units. So we need to compare budgeted costs for 9,500 and compare it with actual cost of 29,000. So our total cost variance is 3 multiplied by 9,500 minus 29,000, where 3 it is our budgeted cost per unit that we can get using total costs, total budgeted cost, and divided them by total budgeted number of units. And we have here minus 500. So when we prepare a reconciliation report and we present all possible variances that we can estimate, we can focus on problem areas at first. In our example, we have two problem areas. The first one is about sales volume, and the second one is about total costs. We may observe decline in sales volume, and we observe increase pressure on our input prices. So these are things that we need to focus on in the foreseeable future. But for this period, in this example, these negative factors have been offset by positive thing, by favorable sale price variance. And if we if we take budgeted profit and we add all variances with proper signs, we get actual profit. So variance report is done. I hope that this video was useful for you. If you have any questions, you are welcome to write them in the comments. And I wish you all the best in studying finance using logic. See you!